If you're looking to boost your investment returns while managing risks like a pro, stick around to learn how a bond ladder strategy can revolutionize your portfolio. Today we're diving into a powerful investment strategy that can help you secure steady income and minimize risk, the bond ladder. Now I know what some of you might be thinking, Michael, bonds are boring, but let me tell you, when used correctly, a bond ladder can be a game changer for your financial future. I'm not sharing this with you because I saw this on the internet and thought it was neat. I'm doing this, one, because I've seen so many customers of the firms I've worked for harness this amazing tool with great success. And two, I'm not just a guy on the internet sharing something I've seen work. I believe in it so much that I actually use it myself. It's such a potent tool for bond investors, from beginner to 30-year plus veterans of the bond business. That's me. So what exactly is a bond ladder? Simply put, it's a way of investing in multiple bonds with different maturity dates. Instead of putting all of your money into one bond, you spread it out over several bonds that mature in regular intervals, say every year, every 3 years, every 5 years, or every 6 months. It all depends on how much you have to invest. This strategy gives you a steady stream of income and the flexibility to reinvest as interest rates change, making sure to minimize locking in lower rates and offering the opportunity to capture some higher rates when they're available. Now, let's break down why you'd want to use a bond ladder and how to set one up. First off, why use a bond ladder? There are three main reasons. One, steady income. By having bonds mature at regular intervals, you're ensuring a consistent flow of cash. This is perfect for retirees or anyone looking for reliable income. Two, interest rate protection. If interest rates rise, you're not stuck with low-yielding bonds. As each bond matures, you can reinvest at the new higher rates. You're also typically capturing greater yield because you're always buying the longest bonds, which in normal interest rate environments is where the most yield is. We'll explain this more when we walk through an example. 3. Reduce risk. By spreading your investment across multiple bonds, you're not putting all of your eggs in one basket. This diversification helps protect you from default risk. For example, if you're investing in municipals, you can buy bonds from different issuers like schools, your state, your city or county, a fire district, a water authority, and so on. Or if you're doing taxable bonds, you can diversify even more by buying U.S. treasuries, U.S. government agencies, taxable municipals, corporates. You get the point. Now let's talk about how to set up a bond ladder. It's simpler than you might think. Step 1, decide how much you want to invest and over what period of time. Let's use a nice round number like $100,000. Step 2, decide how far out or how long of a maturity you want your ladder to go. For this example, let's say we'd like to go out 20 years to make sure we get some really nice yield. If you prefer to do it with something like certificates of deposit from your local bank, maybe you go out 5 years with CDs staggered every year or every 6 months. Step 3, divide your investment into equal portions. In our $100,000 example, going out 20 years, we would be investing $5,000 every year or $10,000 staggered every other year. Step 4, buy bonds with staggered maturity dates. Here's a bonus tip for you. When you're younger, buy bonds that are trading at a discount to their face value, like 75, 85, 90 cents on the dollar to create growth. As your principal grows from 85 to your face value, this gives you both growth and income. Or if you're older and don't believe you'll be around to see a 20-year bond mature, buy a premium bond so you're getting more income from your bond and you're enjoying every day that you do have, with a little extra cash in your pocket, of course. Another example, if you have $100,000 to invest over 5 years, you might buy 5 20-bond pieces, each maturing 1 year apart. Before we get into some of the different laddering strategies, I know I have some skeptics out there who are thinking, why not just save the hassle and buy a mutual fund or a bond ETF? The simple answer is because these give you the same level of risk as an equity mutual fund or ETF, but without the upside potential of the stock market. When you buy individual bonds, you have locked in returns and removed so much of the uncertainty inherent in the market. You know when and how much money you're getting in the future. You get none of that with bond mutual funds and bond ETFs. Now let's look at 3 different strategies you can use with a bond ladder. First, the classic bond ladder. This is the basic strategy we've been discussing. You buy bonds with evenly spaced maturity dates and reinvest as they mature, always extending out to the longest end of your bond ladder. Now, this is the second time I've said that about buying the longest bonds on your bond ladder, but I'm not sure I've made it perfectly clear why we're always doing that. Think of it this way. If today you set up the 20-year bond ladder I mentioned earlier with bonds staggered every year for 20 years, where will your ladder be 1 year from now? The 1-year bond you bought will have matured. You will now have principal available to purchase a new bond. Meanwhile, the 2-year bond we bought is now a 1-year bond, and the 3-year bond we bought is now a 2-year bond, and so on, all the way out the ladder until you get to the 20-year bond you bought. But a year later, it's now a 19-year bond. That leaves you needing to replace the 20-year run. And as I mentioned, in typical interest rate environments, that 20-year bond will have a higher yield than any other maturity you could buy on your ladder. That even works with the 5-year CD ladder I mentioned. This means you're mostly buying the highest yielding run when you reinvest. Pretty mind-blowing, huh? It's actually quite simple and incredibly impactful. 2. The barbell strategy. In this approach, you focus on short-term and long-term bonds, skipping the middle maturities. This can be useful if you expect interest rates to rise in the medium term. I'm not a huge fan of this strategy because I think it relies too much on your being right about where interest rates are headed. However, I've seen this used in a very different way. I've seen it used where the investor bought 5 different 25 pieces in 1, 2, 3, 4, and 5-year maturities, and also bought 5 different bonds with 26, 27, 28, 29, and 30-year maturity. For the first 5 years, they reinvested the principal from the maturing bonds in a new 30-year bond. They anticipated that after the first 5 years, they would be able to afford to purchase the 25 bonds to replace the 30-year maturity. It really worked out beautifully. As time went on, she had built this amazing portfolio of bonds that just seemed to become interest payment generating machines. In my eyes, it was like a piece of art. I hope you're finding this information helpful. If so, it would help me a ton if you would like and subscribe to the channel. Moving on. 3. Required mandatory IRA distribution ladder. This is something I actually did for a customer I once had long ago when I worked for a firm that allowed us to take on family and friends as clients along with our normal bond trading responsibilities. My customer was at the age where he needed to take required mandatory distributions, or RMDs, from his individual retirement account, IRA. We bought zero-coupon U.S. government agency bonds staggered to come due each year, all the way out until the final year in which he had to have all of his money out of his IRA. The primary reason we bought zeros was so, 1, we didn't have to worry about reinvesting small amounts of interest payments every time one of his bonds paid, and 2, this allowed us to know exactly how much he would receive from his IRA each year, and it ensured that we had enough cash available to hit the required distribution amount. It really worked out beautifully for him. And the fun thing, he took a portion of that distribution for him and his wife to live off of, and the remainder he invested in a 20-year municipal bond, which meant he was building a tax-exempt ladder, and we did our best to spread out the payment dates, like a check a month. This meant when he was done depleting his IRA, he still had a nice steady stream of income from the ladder we built outside of his IRA. 4, and as I mentioned it, check a month. In this strategy, besides purchasing bonds staggered in maturities, we also pay close attention to the month in which the interest will be paid. A simple example would be to buy 6 different bonds with maturities every 5 years, 5, 10, 15, 20, 25, and 30. At the same time, each of these bonds will pay interest every 6 months, so we'll make sure we have bonds that pay 1 in each: January, July, February, August, March, September, April and October, May and November, and June and December. With some patience, this structure can be built over time and would have you receiving a bond interest payment every month of the year, a little like a paycheck, and reinvesting the principal every 5 years in the long run. 30 years, where the yields are typically the highest. We have a video about the check a month strategy, and I'll put a card up so you can check that out. This is the strategy I currently use and couldn't be happier with it. Remember, the key to successful investing is understanding what you're investing in. Don't just jump into a bond ladder because all the cool kids are doing it. Make sure it aligns with your financial goals and risk tolerances. Here are a few additional insights about the bond laddering strategy. First, if you're doing your bond investing with a firm that keeps the costs low, that's a great start. But one additional pickup with the bond ladder is you're never paying fees to sell bonds. Your cash to reinvest is becoming available every year because your bonds are maturing. And there's no fee charged just because your bonds mature. The next one, a feature that's not often talked about when discussing bond ladders, is the fact that you'll have available cash for emergencies. Just remember, when things stabilize again for you, to backfill that missing rung as soon as you can. Third, when building your bond ladder, consider using a mix of different types of bonds. This can include government bonds, municipal bonds, and high-quality corporate bonds. This adds another layer of diversification to your strategy. The fact that you're forced to buy different bonds in order to get different maturities creates the opportunity to diversify some of your credit risk as well. Last, keep an eye on the calls on the bonds in your ladder. Try to incorporate as many non-callable bonds into your portfolio as possible. A friend of mine only feels comfortable buying U.S. Treasury bonds. I explained to him the power of the bond ladder, and now he takes his available cash and buys the 20-year Treasury bond during the auction. He came up with that part of the strategy. The 20-year Treasury is non-callable, super safe from credit standpoint. He pays no fees because he's buying them during the auction, and no state income tax, and he lives in a very high income state on the East Coast. And he's typically buying the highest yield on the Treasury curve, as the 20-year typically has a higher yield than the 30-year. I just think this strategy was so neat for him. So a bond ladder can be a powerful tool in your investment arsenal. It provides steady income, protects against interest rate fluctuation, and helps manage risk. Whether you're saving for retirement, looking for regular income, or just want to diversify your portfolio, a bond ladder is worth considering. If you're ready to take control of your financial future, start researching bond ladders today and consider talking to your financial advisor about how this strategy could fit in your investment plan. If you're more of the do-it-yourself type like me, look through current bond offerings on whichever investing platform you use to see what different bonds or each of your years or rungs you'd want in your ladder, and then start building. Lastly, don't get in a big rush. The nature of the bond market supply could mean you're not seeing a bond that exactly fits the ladder strategy you're focused on. Be patient. Rome wasn't built in a day, and neither was a great bond ladder. Until next time, this is Michael O'Donnell saying, always think of bonds if you're looking for an investment where you know exactly what you're going to get and when you're going to get it. Always consult with a qualified financial professional before making investment decisions. Your financial situation is unique, and what works for one investor might not work for another. See the description for the full disclaimer.